the environment around risk continues to evolve. So Moss Adams partnered again with Bank Director to examine the risk landscape for the banking industry. In Bank Director's 2019 risk survey, we looked at risk governance, cybersecurity oversight, the adoption of RegTech solutions to enhance compliance functions, and the impacts of regulatory relief on risk practices. The survey also sheds light on the key risk concerns for the industry, with directors and executives revealing greater unease around credit and interest rate risk. In this video, we'll dig into some important points from the survey that could help strengthen your bank in the next economic downturn. Economists have spent the past 2 years trying to predict the next recession. The regulatory relief package passed by Congress and signed into law by President Trump in 2018 left some to question how banks would respond in the next crisis. Some were particularly concerned about changes in stress testing requirements, since the barrier for requiring annual stress tests was moved from $10 billion in assets to $50 billion. However, I think it's important to note that the industry at large still finds value in this practice. Most banks between $10 billion and $50 billion in assets are keeping their formerly required stress test practices in place. When used appropriately, stress testing is truly a best practice, and the majority of community banks report that they stress test annually. The goal of any risk management regimen is to influence the behavior of and decisions made by management. With that in mind, if an institution is just going through the motions of stress testing, then the benefits will be limited. But stress testing can be highly beneficial when bank leaders incorporate the results in their decisions, because the practice can help bank leaders better understand the portfolio and how it interacts with the current and expected economic realities of their market. At some point, an economic downturn will occur. So, we asked in the survey about the role that boards play in approving loans. As you may recall, the Federal Deposit Insurance Corporation filed lawsuit against directors and officers at banks that experienced serious loan defaults in the last financial crisis. Despite this, the board or a board-level loan committee is involved in the loan approval process at most banks, particularly at banks with less than $10 billion in assets. This is a thorny issue, as many directors believe they have a role to play in loan approvals, despite a lack of credit expertise among most board members. It's a practice we'd recommend that your board reevaluate ahead of the next downturn. You'll want to ensure you're comfortable with the following. Are directors comfortable taking on this potential liability? And does the board have the appropriate knowledge to evaluate and approve loans? In late April, the effective federal funds rate hit its highest point since 2008. The 4 rate increases through 2018 had a dramatic impact on the nation's banks, particularly on their ability to compete for deposits as the market grew more competitive. This was communicated in the risk survey, with almost a third of directors and executives reporting that their bank had lost deposit market share over the past year. If rates continued to rise significantly, most of our respondents believe their bank would lose deposits. So I'm sure a number of bank leaders breathed a sigh of relief earlier this year when Fed Chair Jerome Powell said the case for raising rates had weakened and there were no near-term plans for another rate increase. Ultimately, addressing both interest rate risk and credit risk requires proper oversight of risk management. The risk survey affirms that most banks employ a chief risk officer. For most banks with less than $10 billion in assets, that person focuses on other areas of the bank, in addition to risk. It's imperative that the board meets at least quarterly with the bank's CRO, whether or not this person focuses exclusively on risk. Most banks are doing this, and it's a good way for the board to gain a full picture of the risks facing their institution. Visit bankdirector.com to view the complete results of the 2019 risk survey. You'll also find an in-depth analysis in the second quarter 2019 issue of Bank Director magazine.